I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mates, episode number 12. Thanks for joining us, guys. I'm Bryce, and as always, I'm here with my Equity Mates buddy, Ren. How are you, mate?
I'm good, Equity Mate.
That's good to hear. It's been another fun week for us both, and we're excited to bring you an expert investor this week.
Yeah, so Michael Glennon is the founder of Glennon Capital, and he specializes in investing in small cap companies. As the name suggests, small cap companies are companies with a smaller market capitalization. So, you're not investing in your Combanks or your Telstras. You're investing in companies that are a little bit smaller and potentially have a little bit more room to grow. So Michael has over 17 years experience in financial markets and over 15 years experience as a portfolio manager and a director of several boutique investment management firms. As one of Australia's most experienced small cap fund managers, Michael was one of the first managers of a boutique listed investment company, running the listed investment company Pacific Strategic Investments, which is now part of Brickworks Investment Company, an $800 million investment company. While at Adam Smith Asset Management as a specialist small companies manager, he was awarded the IMCA Money Management Fund Manager of the Year for small cap Australian equities. Michael regularly appears on ABC Radio, CNBC, and the Australian Financial Review, and contributes regular updates on stocks, sectors, and other topics of interest. We're really excited to bring this interview. We got a lot out of it, and we're sure you will too.
All right, well, here with Michael Glennon from Glennon Capital. Thanks for being with us today, Michael. We'll get straight into it. So what got you interested in investing?
I think I had a pretty inquisitive mind when I was young, so I was always looking at different businesses and investments, and my parents worked for themselves and they bought their business off my grandfather, so I'd always thought about working for myself and different things like that. So when I first started out, when I was at uni, I went to uni part-time and I worked at ANZ looking at small businesses, and that's where I started to get that interest in investing in businesses. And I think I just had that wanting to get involved and see what drove businesses. So,
did you study any sort of finance-related degrees?
Yeah, look, I did an economics degree. I liked it. I found that looking at the supply and demand and what affects businesses, and if everyone's making it, it's a really good foundation because fundamentally they're these key things that we look at in investments. So, if you're looking at that basic economics. And in that degree, you do a bit of accounting and a bit of law and things like that. So they're all good things to have, to form that foundation for how you think about businesses. And it's true, that simple supply and demand. I think about business. It's a business that you're buying, and it's no different to us going and setting up a business. And we go and set up a coffee shop, and you really just break it down into very basic things. So, how much did we sell? How much did we sell it for? What are our costs? And how much comes out the bottom? And so all this fancy stuff that goes on in, with capitalising stuff, that's really at the end of the day, if we look like we've got a profitable business because we're capitalising everything, you don't think about it that way when you actually own the business. It's how much cash we've got in the bank. It's about cash. Can we make more? Or, someone's setting up across the road and they're charging less. How much less cash are we going to have? And I just think about businesses from that very, very simple perspective. If I own the business, how much cash am I going to get from the business?
What's one of the hardest things that you found about starting to invest?
Well, when you're young, it's capital. Yeah. How you get capital. So I didn't know what I was doing when I first started. So a good friend from school had sort of talked his way into a stockbroking firm, and they were doing an IPO, and I remember it actually. It was a coal seam methane company. I didn't even understand what that was, so I did a huge amount of research on it, just finding out what it was. So I understood what I bought, because I didn't actually want to ask him what it was I was buying. But I had no money, and he was, and this guy's been very successful. He's retired now, But he said to me, Mike, don't worry, just go to the bank, get a credit card, get a cash advance off the credit card, and there's your $3,000 to get into your IPO. And so I didn't do that, but the thought of that sounded horrible to me. But that, I put a small amount of capital in. I put $3,000 or $4,000 into that one thing. We made money on it. I wasn't sure why. I think I paid 20 cents and sold it for 25 cents. It was good.
Interesting.
It was a good experience.
It's something we try and talk to our listeners about is putting away small amounts of cash sort of each pay so you can get that initial amount of capital to begin with, because not everyone has $4,000 or $5,000 just ready to go to invest, and it's definitely something that is a hurdle for a lot of people wanting to start but don't necessarily have the ability to do so.
I think that's key. If you can get if you get your pay going into your bank account, and then you can put a portion of that, it's so easy now. Like, because when I started, you didn't have CommSec or E-Trade.
Yeah.
You had to call a broker. You had to transfer cash, which meant going down to the branch and doing it. So now you can go and do it, and you can buy it. Brokerage costs are so low. Save enough where it's not going to impact, and just keep adding it.
Yeah, no, it's a good piece of advice. So where's your investing journey taking you, and what have been some notable highlights?
Well, I'm here at Glennon Capital, and I got my name on the door, which is good. So that's the journey.
That's nice.
But it's a great, this is a great business, and investing's good. And if you're doing your own personal investments, you're working for yourself anyway. So your sort of name's on the door. You can print up something to get it at home. But the advantage we've got as professionals as you get to go and you talk to people. So the journey along the way has been really good, and I've worked with some amazing people. So I was lucky enough to, when I was young, my first exposure to funds management, I think I was 22 or 23. I left ANZ when I finished my degree, and went and worked at Mercantile Mutual, and that has produced some of the most amazing small cap managers in Australia.
How long have you been running Glennon for?
This business we set up in 2009. We got a license in maybe 2010, and that's sort of when we kicked that off. Yeah.
And so, just for our listeners, you're a specialist in small cap investing.
Yep.
Can you explain what a small cap is and how you became to specialise in that?
There's 2,200, 2,300 companies listed in Australia. Mixed in amongst that, there's listed funds and different things like that. What small caps are is the smallest. So the very smallest stock, up until our definition of it is anything that's not in the top 100. So we don't invest in BHP, NAB, CBA, any of the top 100. I don't know what's going on there. And I do find them a little bit boring. I think the really sexy end of the market's the small end. They're easier to understand. A NAB is like 10 or 20 of my companies. So everything outside the top 100 by definition is a small cap. The small ords is stocks ranked from 101 to 300. So the top 100 is top 100. Then the next 200 is what the constituents of the small ords. By definition, but that then also leaves a lot of stocks that are outside of the index for us to choose from to invest. So mathematically, it should make it a little bit easier to perform, because your choice set, if you're a top 100 manager, is those 100 stocks. If you're a small cap manager, you've actually got, say there's 2,000 stocks listed, you take off the 100, you've got 1,900, and you're only getting measured against the index stocks in the next 200, so you've got a big set of which you can pick, so it should make it easier to find 30, 40, however many stocks you're owning.
Wow.
That are attractive.
So you're saying theoretically, you're saying that the ASX 200 is actually made up of 50% small cap?
Half of the 200 will be small caps. We don't really invest, we're more skewed towards the smaller end, like under 300 mil is really where we play, because I think you can get businesses. It's a lot easier to get a business that goes from making $1 million profit to $2 million than to get a company that's making $50 million to go to 100 in terms of profit.
Well, going off that then, what is your investing philosophy or style?
It's common sense. I always view it as I can only have one investment, so any one of the stocks in the portfolio. So I think of them, number one, they're businesses. We're buying a business. You're not trading shares or whatever. You're buying a business. So that leans us towards thinking, well, investments need to be longer term because it takes, more than 3 to 6 months for, the decisions that management are making to come out in share prices and affect the profit. So, we're buying a business. The business we want at some point in time, if that was our only investment, to be able to generate income from that investment, preferably dividends. However, with small caps, a lot of them are using all that capital to grow, in which case that's fine. Because we're seeing the value of our asset increase all of the time. And we're there as a partner to provide them with capital. That's our role if we understand the business, and that's a good situation. So, as I said before, if we went and opened up the coffee shop downstairs and it's growing and we want to go buy some seats and we want to put some umbrellas up because it's growing, we're selling more and more coffee every day, we might actually not have any cash profit. And then the growth actually could be a problem that we need someone to bring someone else in to help us get bigger. And so that's our view on the small caps. If they're not producing cash flow, we're happy that the business is growing.
So if you were to put it in under an umbrella, we talk in the show about value investing or growth or momentum, and you would put yourself in the growth?
I can tell you what I don't put myself in. I don't put myself in technical analysis because I don't understand it at all.
Yeah.
I just think I'm buying a business.
Yeah.
So, we're looking long term what we think can happen with the business and where it can go. So we're just buying businesses where they're listed. We do buy some unlisted businesses here, so there is no sort of liquid market in them. It's about what we value the business at, what the management team is doing. But we do have some growth and we have some value investments. And I've always struggled, and we've had a few missed opportunities. So one of the things we've never owned is REA Group, the realestate.com business.
Yeah.
Because always to me it looked very expensive, and if anything I was probably a little bit cheap not wanting to pay up for it. I've gotten better at doing that by saying, hey, here's a good business, it's got good people running it, it's got good prospects, however it looks expensive. But if you can say, but hold on, I might be paying 50 times in terms of PE now for this business, but what is it going to be 3, 4 or 5 years out? Just being a little bit longer term and a little bit more strategic about that investment. But we don't want to pay for blue sky. We've got to really clearly be able to see what that company's doing, how it's getting there, and what's happening in the market. And I couldn't do that with an REA.
So examples that sort of come to mind for me with that is Bellamy's and A2 Milk. I got in at Bellamy's and then didn't get out before it hit the floor, and A2 Milk is trading at a very high PE at the moment.
Exactly, yeah.
And,
but they upgrade their profit again a couple of years ago.
So Alec, who is the other co-host, and myself sit back and go, Alec is in A2 Milk, but I'm not, and I'm thinking, is it too expensive? And it sort of along the lines of what you're saying, am I just being too cheap because still 4 or 5 years down the track it might be
that's the challenge.
To grow. It's
and
like, how do you know?
Look, that's the challenge with the business. But I'll give you another example of something.
Okay.
So one page was listed, and it was a new paradigm getting a job, and so they were going to use this big Facebook and different social media to sort of be able to bring people in. And it was going to save a lot of money for big corporates using it. Who were getting thousands of applications coming in, and they were sort of going to make the whole lot a streamlined sort of process. And so the shares went from 20 cents, and I think they went up to like $6.80. So you would have made a huge amount of money out of it. And because it was running up so much, I thought, well, maybe I'm missing something. I'll have a look at it. And so we started to do some research. And firstly, I couldn't understand it. So I can't invest in anything I can't understand. And I think that you're best, if you don't understand it and you spend a bit of time trying to understand it, just stay away from it. There's 2,000 companies out there I can invest in. Just find some that you understand and that you understand really well. But with one page, what we did is I went back and I had a couple of presentations which I downloaded from the stock exchange. And this is stuff that anyone can do, and it's a common sense sort of filter. I thought, well, I'm clearly missing something. But when I go back to the accounts, I'm missing even more because the revenue was less than $300,000. It might have been $250,000 for a half or a quarter, whatever. It didn't justify the $600 million market cap company, and I would never been able to, feed myself if that was my only investment. And yes, it had grown, but that's just pure speculation because I went through and I actually got on LinkedIn, and in the presentation she had 4 or 5 companies that they were working with, big blue chip companies in the States. So I emailed the chief technology officers of all those businesses, and we had great little banter on the email, and then all of them didn't respond when I asked them. We had banter about one page, what they would be prepared to pay for that service, and not a single one of them replied to that email, which made me think none of them are going to pay anything, and they were all using it because it's a free trial, and it was obviously free because there was no revenue coming into the business. And now that stock's suspended, you know, they're kicking her out and it's back at 20 cents at $1. You know, we were talking about shorting it. You know, we did. That was one where we got in there and I couldn't understand it. I did some work on it. I should have been able to understand it and I couldn't. And as a result now, you felt bad when it was running up and there's this fear of missing out. Should I get in? But on the way back down...
Interesting. Well, you mentioned in there that one piece of advice is to, for someone starting to invest, is definitely invest in something that you know and understand. Is there any other pieces of advice that you would give to someone starting out?
I think that it's that common sense. Just think about it as you're buying a business, and you know you're really just buying an asset. So it doesn't matter whether you're buying a business or if you're buying a car. You've always got this decision about you're buying an asset. So it's not trading shares, and as I said, look, I don't understand the technical stuff where these lines all cross each other and they go up. I don't know anything about it because I think I'm buying a business, and I go out and I see a lot of these companies and I talk to the people running the business and they don't talk about the lines either. So if you're thinking about it, it's about value. So if you know that you want to buy, you know, a 5-year-old Commodore and it's worth $20,000, if you can pick that up for $18,000, you sort of instantaneously made money. And you look around and you look online, you go see it, and it's the same with shares. If you know that, you know, I don't think coal companies are great, but if you can pick up one on a P of 3 or 4, and you don't think there's any sort of downward risk in terms of the coal price, you're getting a bargain. So look around, hear through, you know, ignore all of the noise. We've made good money just by having common sense. You know, if a company misses a number, you know, forecast earnings number by a small amount, and you've seen it just happen in its reporting season, and the share price is down 30 or 40%. That business is not 30 or 40% smaller because they missed a small target. So I think it's just common sense, know what you're buying, and having a bit of conviction, because to make really good money out of shares, you have to own them for the long run. You know, you have to start, and if you start when you're young and you hold them for a very long period of time, you can make, you know, fantastic money. I wish I'd never sold a share, because I've had some amazing things that I've sold too early, and I've gotten better at holding them.
That's a really good piece of advice, and it's something that I'm still learning as well, is the value of patience and the value of time when it comes to this sort of stuff, and compound interest as well.
That's the big thing, the compounding. Reinvest your dividends. It's like free money, the reinvest. You know, it's just so important, that compounding and reinvesting. And you know, I saw something the other day that, and so this is relevant for young people. If you invested something like $5,000 when you were 14, which is a big ask, I guess, but then you only put $1,000 in a year until you're 19, and you reinvest all of your dividends into the market, you know, you end up, and it's a long period of time, but just from that small investment with $265,000.
Wow.
Something of that magnitude, you know, it's a big number just from a very small investment, and the compounding at a low rate. So, and then if you add to that all the time, and that doesn't include adding to it, and then if you add just a little bit of money to that, you know, $1,000 a month or whatever it is, you know, you end up with a very big portfolio.
Well, what has been one of your best investments? And this doesn't have to be a financial investment. It can be anything that you feel has been of benefit towards your investing career.
Yeah, look, I think the best investment for me, this is going back a long period of time, but and I'll be really honest about it, was a company called REAC, which was formerly Reinsurance Australia Corporation. It was listed. It was a reinsurance company, so it was providing insurers with insurance, and it went into, they stopped providing insurance and they wound down the book, the insurance book. And this is where one of those things we do talk about doing analysis. And so to be honest, I bought it at 28 cents and then I sold it at 26 or something like that, and I lost a bit of money there, and then I bought it at 24 cents and then I lost money. But the whole time I kept trying to work out, I knew there was a big asset base within the business, and I knew that for each of the insurance claims, and insurers don't like to pay out money, they try to fight you to. And so, you know, I wrote it, I lost money like consecutively all the way from, you know, 20 cents down to 28 cents down to about 7 cents. And I bought them at 7, and that was the very bottom of the market. And I bought more at 15, and I way surpassed the small amounts of money. You know, I sort of had a bit, and we still do it here I sort of had stop losses in, so when I got down, I wasn't losing too much capital. But I was convinced because the amount of work I'd been doing, and so my timing wasn't right in terms of when I got in. I probably should have waited till it had started to turn a little bit, and that was when more people. So I think I was probably onto that idea a lot earlier than most people, because if I'd been late, it would have already turned. But people started to work out, hey, look, there's a big pool of money, and I ended up from 7 cents, making 10 times my money on that investment, and that paid for. I was able to go out and have a very nice deposit for a house or an apartment as it was back then, and so that helped. Being there, and I'd done the work, and I was convinced. And then we had a similar sort of situation with, and it was nice because I'd had that experience. We had a similar situation with Rams and that business when it went through a similar experience. So there's been a lot of good investments that we've had. Well, not a lot. There's been 5 or 6 that we've made amazing money out of that don't come along that often. I'm looking every day, and I've probably had 5 that we've made 10 times our money on. But it's there getting in, doing the work, keeping an eye on things, and that wasn't a growing business. They were asset plays that were right, and that's a real value type situation. So
it's also another good thing to point out as well that not everything is a win, because I know starting out, a lot of people often think that this is a quick win game. You put money in and you hear all of these crazy stories of people making 10 times, 20 times their money, but they often forget to tell you how many times they've lost their money. So it's comforting to know that one of your best investments has been one where you bought in and actually you lost money before you made. So
yeah, I lost money 5 or 6 times, but you have to be careful about these people that do have that perception that the stock market's this quick money type thing. I know hundreds of people that are in the stock market. I know people that made a lot of money out of it and are retired, but you still hear stupid stuff. I was in a lift the other day, and there was people talking in front of me, and someone said, "Hey, I've got this stockbroker, and he's the type of guy you give him 10 grand, he turns into 100 grand." It doesn't happen.
No.
So it was enjoying to hear the conversation about these people talking about stuff, but it doesn't happen. The people I know that are the best investors that have made significant amounts of money, it's taken them a long time to do, and they don't. And you get that you talk about compounding. The other thing is not paying tax. So if you think about it, if you had say you bought Macquarie Bank at $25 a few years back, and it's close to $100 now, and you've got to pay tax on your profit, and depending on what your rate is, whether you've got it in a company or whatnot, that share price can come back a long way for you to be in the same net position. So, getting that free loan off the government, and that's part of the compounding. Warren Buffett doesn't sell, a lot of shares. They've held a lot of those investments for a very long period of time. So that adds to your compounding. If you're doing this short-term trading, and every time you make $1, you're going to pay, depending on what you're earning, but you're going to pay, up to 50% tax on it. You're sort of shooting yourself in the foot to get that compounding effect. So you buy them, you hold them. If you want to diversify, don't reinvest the dividend into the same stock. Reinvest it into something else. And there's that. Look, I like the Warren Buffett stuff. I don't think the market operates the same way as how it did when he was starting out. But if people want to look at stuff and you read his stuff, it's common sense. A lot of it, it's very simple.
Do you have a must-read book that you would recommend to people just starting out?
Look, if I had to give a list, I could give you 7 or 8 books I think are great books to go and read. I think you go and read all the Berkshire Hathaway annual papers because I think it's common sense. I think there's a couple of people who've done studies on the investments that Berkshire Hathaway made in the early days. I personally like, for a bit more entertaining value, I like financial markets history or books that have been written about periods of time. So, I've read books on, early entrepreneurs, in like the big families that did well in the US, developing the US. Trevor Sykes's books here on things. So we went back and we bought a copy of Money Miners, which was his book, I think published in 1978, about the Poseidon boom. And that was people retired off the Poseidon boom, but it only went for about 3 months. And it was a very interesting story about resources in Australia, but that really puts it into context, and it's got a bit of a numerical basis. You can get a copy on Amazon or somewhere for $5 or $6. It's cheap, it's a pretty old book. So things like that are interesting. Looking at what happened in the .com boom, Look, any book you can get on finance is good, and reading about what happens so you become more knowledgeable and make you a better investor over time.
So you're obviously a specialist in small caps. Is there any particular industry that you're focusing on at the moment?
Where we look, we're more bottom up, so we don't try and. The one industry where we've got an investment now, where we did specifically target the industry, was the real estate industry, but we didn't target it because we went out and looked at real estate. We target it because one of the themes we look for in our portfolio, which is good for small caps, is disruption. And it's a trendy sort of word, but it's always been there. So you had all the ISPs were disrupting Telstra because Telstra was doing, dial-up internet, and these guys were then able to buy sort of wholesale of Telstra and be smaller, operate at lower costs. And Telstra, getting back to economics, the area under the curve for Telstra to drop their price just a little bit meant they would lose so much money that they just didn't do it. So all these little players were sort of like feeding off the carcass of Telstra, and they developed into big businesses. So look at TPG, and that was really disruption in that space. And so we had a look, what's left to disrupt now. And so fintech is a big area where we've done well out of. But I think the next one for us, one industry I see that hasn't been, and every time I say this, we get emails on our website from disgruntled real estate agents, but real estate hasn't really been disrupted. So REA and Seek disrupted classified advertising, but real estate agents are still charging 2% to sell your house or open the door and show you where the living room is. So I think that will get disrupted, and you're seeing it now. There's Buy My Place, which is an interesting small business. We don't have a shareholding in it, but we're watching it. There's Purple Bricks, which is advertised on TV, and they've got now fixed. They'll sell your house for a fixed price. It's about $5,000. And then we have a business that we've got investment in, which is unlisted, called Local Agent Finder. But it's all about stockbroking. Used to charge 2% commission rates, and now I can trade as an institutional guy for 7 or 8 basis points. So massive price cuts there. And so that's been disrupted through things like CommSec and E-Trade, lowered the price. So now that filters through the rest of the market. In real estate, the price has dropped on Buy My Place and Purple Bricks, and I see that will shift and give a bit more price competition to the other guys. So it's a matter of picking who will do well. So we have a comparison website we're investing, because I think it will take a very long time for property to get disrupted. Okay. Travel got disrupted with things like Webjet, and we sold out of that too early. We were in there very early in the piece, and I think we sold it at about $4. And it's kept going up since then, because I thought everyone's using Webjet, it's over now. But the vast bulk of people are only just, your mass population's only just getting into that. So I got that wrong. We got out too early, but we still made a profit. You don't go broke making a profit, but it went up a lot more. Yeah. But it was that dynamic of people shifting from going to the travel agent or calling the travel agent to doing it themselves online. So I think that industries that do have high barriers to entry are the things that are... Look, there's no barrier to entry to becoming a real estate agent. It's a 2-day course to come. But to build a brand in that industry is hard. So on the disruption, finance has been disrupted, and there are big barriers to entry. But the barrier is capital. And so capital, if you've got the context... if I set up a business that wanted to provide some sort of... so we've got investment in Zip Money, and Afterpay has been a very successful company that is similar to Zip Money. It's different but similar, but they've disrupted because they're bringing technology in, and then they can raise capital at the same time. So the barrier is capital, but...
I like the idea of Afterpay.
That's an important point about if you live beyond your means and you constantly have a credit card and you're buying stuff on with Afterpay or Zip Money or whatever, it'll be hard to achieve those financial goals.
Something that's been trending, and I'd like to know your thoughts, has been medical marijuana industry. Is that something that you're keeping an eye on, or you think it's a buyer beware, or what are your thoughts on that?
It's an agricultural stock, and throw into the mix that it's an agricultural stock that's got highly regulated, licensing issues. That's my view on it. I think I can go buy an almond crop and it's unregulated, but it's subject to all the same factors that most agricultural stocks. I'm sure some of the businesses will do well in that sector, but it's just a crop. at the end of the day, and I think it's got a very small end market.
Right. A video that you recently did on your website was about volatility.
Mm-hmm.
And something that I hear a lot of my mates talk about, people starting to get into it and they read it in the media, is how do you capitalize on a volatile market? You know, should we buy the index or jump in on a listed investment company that's following trend, that sort of stuff? What are some ways that you think beginners could capitalize on a volatile market, or is the market at the moment a buyer beware as well, in the sense that...
No, I think I love volatility. That's probably what we said in the video. You know, volatility is really good if you know what you're buying. So for us, I'd probably have at any point in time, we only own about 40 positions in the portfolio. I've probably got 10 orders on now, a bit below market. I'm very patient. Sometimes I don't always get my stock, but because small microcaps are pretty illiquid, you know, there can be a 5% spread between the bid and the offer price. So I'm happy to sit back. I'm happy to be patient. I'm happy to get my stock. If you read that stuff on Warren Buffett, in some of their investments, it took them 2 or 3 years to get their investment. So if I'm patient, I get stuff at the right price. And all the analogy is, if everyone thinks the world's going to end and they sell off, you know, a heap of stocks, it's like buying your $20,000 Commodore for $18,000. And if you keep picking up $18,000 Commodores, you know, and they're worth 20, and you think that they're worth 40, you just get that little bit extra incremental return. And then I look at our shares in our listed investment company. I was surprised. Our largest individual shareholder, other than myself, was he told me what his average price was, and I was surprised. So he's just sitting there in the market, and when he thinks we get sold off because either someone's changed in their portfolio or they found something better to buy, he just sits there and picks them up cheap.
Wow.
Basically, he capitalizes on the stuff we're capitalizing on, the volatility as well. If you know the business, if you're comfortable with the business, and we're doing work. I'm excited now because we have seen all this volatility, and you've got like Osforex has been sold off. You've had Ardent Leisure has been sold off. Adairs has been sold off. Godfrey's has been sold off. RCG Group's been sold off. You know, Retail Food Group's done. There's Myers been sold. There's carnage out there. Yeah. I like that. It's like, whew, everything's half price. You know, and I've got to work out what we want to get out of all this half price sale, and we're not rushing into any. But some things we bought straight away. But
surely in some instances that's because some of those businesses are crappy businesses.
Yeah, but when you find the one that's not crappy, that's the one to buy, and it might have been, you know, the baby being thrown out with the bathwater. There's nothing wrong with the business. So,
do you think the market at the moment is like teetering on the edge, or is it overvalued, or in a broader scale, and then also in a small caps?
I have no idea whether the market's overvalued, because the market, when people talk about the market, they talk about the index and the index level, and the index level is like 90% top 100, and out of the top 100 it's something like 50% banks. I don't know anything about the banks. I look at a lot of businesses, and I don't think that I don't like the price they're trading at. So we run a watch list of about 200 resource companies, and maybe about, I don't add it up, but maybe 400 or 500 industrial businesses, so that we can keep an eye on all them. And if anything happens with the price, every week we review it, and it spits out things. We put a price in where we think that business is worth for what we know. We're constantly updating it. We've got a couple of young analysts that do that, and you know, that helps us keep track of this big list of companies. So I don't worry so much about the markets on an individual stock basis. What's that business worth? I'm getting it cheap. And we go and see a lot of companies, and sometimes we get things wrong, or the business is better than what we thought, or it's worse than what we thought, and we change the price. Because there is a price for every business, and I'm ignoring the stuff that are not real businesses, like the one page. That was not a real business. So real businesses that make real cash flow, where people turn up every day, and you know, there's cash coming in at the end of the day. There's always a price for those businesses. And the lower quality businesses, so if you look at your Porter type factors that don't have barriers to entry, things like that, the better the business is, the higher the multiple you want to pay. The more commoditized the business is, the less you want to pay. So if you just remember those prices.
Like Amazon's trading at 177 at the moment or something.
Yeah, it's a good business. It's done well.
Yeah.
He's been amazing. I feel I was on the furniture review, and Bezos was standing next to me, so I thought, okay, I've just got to if I move one space over to the right in the furniture review, and it was a separate article, but no, but he's been incredibly entrepreneurial, and we talk in some of our videos about not investing with people who have had a bad track record. It takes you a long time to build that up. I've been doing this, a long time now, so I remember the failures that people have had. But you can look yourself about where people have been before and what happened with that business. It's hard to gauge unless you've been there. It's an experience thing. But the other thing is I've got a huge amount of time and some of our best investments have been with owner-operators.
Yeah.
And so it's someone that knows that they may not take a huge salary out of the business because they get their wealth grows through the business doing well and the share price appreciating. And they'll make a decision that they think will be best for the business over the next 3, 4, 5, 10 years. Whereas quite often lower quality professional managers will make a decision that's right for them to get the maximum amount of their short and long-term incentive bonus. Yep. And there's been studies done on that. And you can see there's been, I was talking to a hedge fund guy about the other day, and he mentioned a couple of companies that all those directors and CEOs should be put in prison. He felt very strongly about it. Yeah.
Wow. So, I mean, Amazon is making a profit, but proportionately to its revenue, it's very small. And when we're talking small cap, something that I like to look at as well is obviously if it's generating some revenue, it's not pre-research on top. That's micro caps. What's your opinion on, you talk about cash, but are you talking revenue or are you talking profit, or what's the interplay between the two?
Look, when you look at, so if you go back to the dot-com boom, it's probably a bit before your time, but it was amazing how many of those companies were able to build revenue very quickly with no profitability. So it's how sustainable the revenue is going. So if it's not making a profit, in terms of a cash sense, you've got to look at what's happening. So you've got to look at the cash flow statement, what's happening to the profit. So you want to make sure when there are all these high growth, I don't like these tech type startups where you get a room full of people and it's a great place to work. They've got a ping pong table, they've got a bar, a fridge here, and it's full of stuff. But you want to make sure that, if it's not making money that's growing revenue, that the revenue is sustainable, recurring, or that they're building something that it will get a lot bigger. I've struggled historically with businesses that trade on very high PEs. I mentioned REA before. I've struggled with that because I do just like buying businesses that make cash, that are growing. They've got someone there that's got a vision. If they're going to raise capital off shareholders, that they're going to make sure that capital is incrementally more accretive and adds value to the business. It's a big thing. Then
from an economic standpoint, where do you see the broader economy, and how's that helping or maybe disadvantaging small caps?
Well, I have this fundamental view. If you look at the equity market over the last 50, 80 years, it's grown. And it's had periods, like decades, where it hasn't grown. So we try and buy a portfolio of businesses that we think will be bigger or generate cash flows. So when I look at the economy and where I think it's going, I more look at the businesses we've got. And then in the context that the market has grown, the economy is growing, there's GDP growth rate, and so there's an inflation rate. So provided that the economy is growing and the world's growing, the market should over time get bigger. If you look at the constituents of the ASX 100 now, they're not the same companies that were the constituents 10, 20, 30 years ago. You want to get into the businesses. The nirvana situation is to get a small or micro cap company and ride it all the way up and let it become a big cap, and it's in your portfolio and you've never sold it. Maybe you make 100 times your money. It hasn't happened to me yet, but that's so. I just think I'm not so much worried where the market's going short term.
Yeah, right.
As long as there's nothing that's going to impede growth in Australia and make us go backwards, as long as we have that rate of growth, whether it's 3, 4, 5%, I just need to get companies. And I always ask myself, can this company grow faster than the rate of GDP over a long period of time?
If you were to give a piece of advice to encourage someone to start investing, what would you say?
I think it's daunting. I think if you want to be if you're very conservative, which you should be with your money, I think there's easy ways to get in. I think that the easiest way just to get used to the process is to buy. If you take a long-term view and you're buying something that's sensible, that if you want the lowest risk approach, because the market over time does go up and in the short term you might lose some money, buy an ETF of the index. It might go down 3-6 months, but I'm pretty confident, over the next 3, 4, 5 years, as the economy grows, the stock market will grow, and you won't lose money on that. So that's the basis. Then you've got familiar with the process of buying and selling, how it works, and using whatever software you're using. I think CommSec and E-Trade are great platforms. And then I think after that, if you want to do it in a low risk way, look at some of the LICs out there. Some great people managing LICs, not because that's what we manage, but because they're listed. And I think the ASX is a great platform. The ASX is such a great platform. You buy our LIC, and you go to the ASX announcements, and you can see what our NTA is every month. Yep. There's commentary on what we're doing. There's annual reports there. You can look at the balance sheet of the business. You can see, there's no gearing and things in it, so you can start to get familiar that way. But then there's the common sense thing. It's like buying, it's like the buying the car, and that's why I make that analogy. You're buying a business, so do you like the business? Buy it,
I'm happy that you've said that, because in our previous episodes we actually talked about ways in which you can find some companies to invest in if you had no idea, and one of them was just to look around your day-to-day. If you work in a shoe shop, for example, then look at the brands that are selling the most, and then have a look at those sort of companies. So
that's great. So if you work in a shoe shop and you were there now, you would know that right now this year that apparently Adidas has it all over Nike. No one's buying Nike.
Really?
And little things, this is a good example. So we talked to, I saw the share price of RCG, which owns Athlete's Foot and owns DC Hype. Okay. So it went from $1.40, I like cheap stuff, so I went from $1.40 to $1. And I got straight in the taxi, and I went out, I rang them up and went out and saw them, and I spoke to the guys, and I got a bit of a feeling that it was going to be a bit soft, so we didn't buy any shares. And then they've had a subsequent profit downgrade, and that business is now, it's gone from $1.40 down to $1, and then it went straight down to, it's about 68 cents now, so it's even cheaper.
Wow.
But on the weekend, and this is another thing you can do, I've got a separate email address, and for the retail guys or anyone, if we're looking at a business, I go to their website. If they've got a newsletter, I subscribe to their newsletter.
Okay. So
I don't go to that email a lot because it gets spammed heaps by all these people. But Rebel had a sale on Saturday. They put out 20%, one day only, 20% off everything in the store at Rebel last Saturday. So the two good things, you subscribe, you can get everything cheap when there's just one stuff. Secondly, it's a bit of a lead indicator that these guys are really, it must be a bit weaker than what they thought. Yeah. Is it going to affect the result? So it's good to have all these subscriptions to different things. So there's little bits and pieces that you can always do to start to check. Yeah.
No, there's some good actionable things that I think are of value, and also even subscribing to your weekly videos I think is a great opportunity to get access to people like you free. Like the amount of free information that's out there is fantastic. I just wanted to quickly go back and say for our listeners that LIC is a listed investment company, and an ETF is an exchange traded fund. And that Glennon Capital is a listed investment company specialising in small caps, which we've discussed today, and they are open to retail investors like myself. But I think it's been great, Michael. Thanks for your time. Really appreciated you coming on the show. You've had some great pieces of advice, and so really appreciate it.
Thank you.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.